Hey, welcome back. It's Jason Walter here. In today's housing market update, I have a lot of information to share with you today, including news regarding mortgage loan forbearance numbers in the US, because the number of forbearances actually dropped by the largest amount in 6 months. I also have news regarding mortgage interest rates because those have decreased as well recently. And lastly, I have an update to share regarding home prices in the US, including which states and cities had the highest price appreciations and which states and cities had the lowest. And before we get started, please hit the like button. I greatly appreciate that. And also consider subscribing as well. I post videos about how this pandemic is affecting our housing market. Also, don't forget to get your 2 free stocks. I'll leave a link below for that. Okay, let's first go over mortgage loan forbearances, because according to the data analytics firm Black Knight, they actually posted today that forbearances dropped a whopping 228,000. And that's the largest decrease since last fall. This decline was largely driven by homeowners exiting the forbearance plans at or around the 12-month mark. Overall, an estimated 280,000 borrowers exited forbearance this week. Personally, I found it very interesting that a lot of people exited their forbearance plan because a lot of people can do an 18-month forbearance. In any case, forbearance plan starts, which include restarts, have improved over the past 4 weeks. They are now down 18% from the previous 4-week period. Now the number of homeowners in forbearance has decreased to 2.3 million, and that represents 4.4% of all mortgages. Black Knight also reported that more forbearance exits are expected in the months to come. This is because there are approximately 500,000 additional forbearance plans with scheduled expirations at the end of April. So we could have more homeowners who end their forbearances in April and May this year. All right, let me break this down for you and give you my honest opinion about what impacts this may have on our housing market. We had 280,000 homeowners who just ended their forbearance plans. We also have a potential of 500,000 more that could end their forbearances in the next 30 days as long as they don't extend it for another 3 to 6 months. Therefore, that's a total of 780,000 homeowners. So the key questions here, of course, will be how many of these folks will actually sell their houses, how many will enter into some sort of payment plan or loan deferral, and how many are going to refi. The truth is, no one really knows, right? But if history actually repeats itself, then approximately 7% will either refi or sell their houses. That would equate to approximately 55,000 homeowners. And just for argument's sake, let's just say that all 55,000 of these homeowners decide to sell their houses. But in my opinion, that's not enough to crash our housing market. And let me explain. This is because our current housing inventory in the US is around 1 million units. So an increase of 55,000 houses listed for sale will barely have an impact on our housing market, in my opinion. However, I'll keep a watchful eye in the months to come, and I'll be sure to keep you updated because a lot could change, right? We still have over 2 million who are currently in forbearance. All right, changing gears slightly, let me give you a mortgage interest rate update, and then I'll share an update regarding home price data with you. According to Freddie Mac, as of yesterday, mortgage interest rates dropped to 3.13%. That's down from last week when it averaged 3.18%. Freddie Mac's chief economist Sam Cater stated the following: after moving up for 7 consecutive weeks, mortgage rates have dropped due to the recent modest decline of the US Treasury yield. And he's absolutely correct regarding this because you can see this in this chart of the US Treasury yield over the past 5 days. So 5 days ago, the yield was approximately 1.72%, but now it has declined to around 1.68%. All right, let me share the latest news for home prices in the US. And this is thanks to CoreLogic's Home Price Index, or HPI, for February that was just released a few days ago. And just so you know, CoreLogic's HPI tracks home prices in the US for single-family houses. This index is normally released on the first Tuesday of each month with an average of a 5-week lag. That's why this data is from February, even though I'm reporting it in early April. And by the way, this is different than the Case-Shiller Home Price Index that I reported on just a few days ago. In any case, CoreLogic reported that home prices increased by 10.4% from February 2020 to February 2021. That sounds like a fairly modest price appreciation, right? Well, not so much, because this is the highest year-over-year gain since April 2006. The increase of home prices is obviously due to record low inventory and record low interest rates, right? However, CoreLogic is forecasting that home price appreciation may slow as affordability worsens and if interest rates increase. Because of this, CoreLogic is forecasting that home prices will only increase 3.2% from February 2021 to February 2022. So I'd love to know your thoughts regarding this, so please comment below. Do you believe this forecast is too low? Do you think it's right on target, or do you think it's too high? In my opinion, and this is pure speculation because we really don't know what's going to happen, right? But if I was to speculate, I believe that home prices will increase by double digits this year, but only if inventory and rates do not skyrocket. However, as home prices continue to increase, then affordability is getting worse, right? So this is definitely something to follow. All right, going back to this report from CoreLogic, they also noted that home price growth accelerated for all 4 price tiers to the highest rates since 2005 for the low price tier and since 2006 for the other 3 price tiers. Okay, let's now discuss the states that had the highest price appreciation versus the lowest. Every single state in the US experienced an increase of the HPI, but Idaho led the pack once again with a whopping 22.6% increase, and that's nearly double the rate from 1 year ago. Followed by Idaho, where the highest price appreciations were Montana, South Dakota, Arizona, and Indiana. In contrast, the 5 states that had the lowest price growth were Illinois, North Dakota, Hawaii, New York, and at the bottom of the list was Washington, D.C., with an HPI increase of only 4%. What I found very interesting was the fact that Connecticut had one of the biggest price appreciation accelerations for the time period February 2020 to February 2021. This is because home prices were actually falling by 0.6% in that state in February 2020. But it turned around and now is increased by 14.8% in February 2021. CoreLogic noted that this turnaround was partially due to the fact of an influx of buyers who moved from cities in nearby states. Okay, let's have a look at the top 10 metros in the US to see how those fared. So Phoenix actually led the way with a 16.2% increase in the HPI, followed by San Diego and Denver. In contrast, Houston, Boston, Miami, and Chicago all had positive price gains, but were well below the top 3 metros. Let's now discuss the top 5 cities at greatest risk of a home price decline, at least according to CoreLogic. At the top of the list was Brownsville, Texas, followed by Port Arthur, Texas, Lake Charles, Louisiana, New Haven, Connecticut, and then Miami, Florida. If you enjoyed watching this video, please hit the like button. I greatly appreciate that, and also consider subscribing as well. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and look forward to seeing you on the next video.